And when all three combine, we have peace of mind. So a quick round on how the session is going to be. We finalize the objectives. We understand the problem statement, which is the data from the survey. Based on the data, I have identified the pain areas in pure numbers. We outline the solution. We suggest the approach that we have. What I believe is a secret for optimizing returns and reducing risk is not what I'm going to discuss. We will have a few slides for the sample of how the actual data has performed. Now, to communicate in a more confident manner for the reader and for the viewer, I would showcase what has been our approach so far and how well we have done. The next slide is going to address the pains, the way they are identified in the objectives and the current pain. Thereafter comes the offer. Lastly, a thank you, and the session will be open for questions and answers. It's always good, as professionals, we have a certain objective, a certain outcome in mind. And if you drill down for every particular activity that we do, whether we are a student, whether we are a working professional, whether we are business people, at the end of it, we choose to have peace of mind. Now, there are many factors which affect the peace of mind. But as they say, money is like Dettol. It kills 99.99% of your problems. It's better to be rich than not to be rich. And the only better way is to add value to the society. But at the same time, as we progress in age, as there are competitions, our wealth should outgrow the inflation so that we maintain our same lifestyle. We should be sustaining any unexpected market conditions without getting worried. We should be able to extract regular monthly cash flow, and our liquidity is not hampered at any times. When I say liquidity, you have access to your money when you need. Lastly, as each of us is unique, we should have a comfort for the risk that we are willing to take so that we can aim to reduce it and at the same time grow your investments. So this is a very general data, but a very comprehensive one. This was surveyed jointly by Canara and HDFC Life Insurance across 800 people between age 20 to 50, quite a variation. And this is the outcome. 66% people who are interviewed or surveyed are not prepared for retirement. Some people have not bought the term insurance. This borders onto wealth and protection as well. Very few people review it over the year. And now what I'm going to present to you is the data coming from the actual survey that we did. We sent across a questionnaire to 500 people. Out of that, 267 have responded, and the age band is between 40 to 50. Now, I would urge you to see the parallel. 87% of the people are concerned about inflation eating away their savings. So in pure numbers, it's more than 230 people, or 267, are concerned about inflation. 33% are not ready for any unexpected market corrections. On an average, 10% of the people, 10% of the people are close to okay with a 5% drop, and at max 20% drop is something people anticipate. While that's a good and a mature way of looking at things, but 1/3 of the people who have answered are not ready for the corrections. Out of the 267, 38% of the people have not evaluated their investment portfolios for risk and performance. मतलब जो हो रहा है चल रहा है देख लेंगे, which is something which we would not encourage to. And the very good part, more than 80% have shown a proven method shown an interest to learn or know about a proven method to safeguard their investments without losing their returns or higher cost of fund management. There are many exotic products in the market, and if you're out in the market with a decent bank balance, you will be sold practically everything which is there to be offered. That's where a professional comes in, and we make sure that we align your portfolio to your goals. In the survey, 20% of the portfolios are not aligned to any goals or milestones. So our endeavor is to answer these queries, answer queries which are very general but very important on the retirement part of it, how we can use the knowledge and the skill set of the professional which we are dealing with in your own best interest. So as we endeavor to outline the solution, this is a very general approach. You have an income, you have a certain working age, and that is what income that you're going to bring in. Now there are expenses as we live, living expenses, there are luxury expenses, but we also have to save. And only what the amount and the capital that we save and invest in the proper way is where we are going to create a safety net or the wealth. So beautifully done in this particular small image. So simple, invest into appreciating assets. Optimization of returns is achieved by asset allocation. What do you mean by asset allocation? Simple. If you need the money for the next 3 years, you keep them into a safe instrument. But if you need the money after 10 years, safety may not be the prime objective. It should be invested with a proper risk management in place. When we say lower the risk, how do we lower the risk? The way we segregate a larger task into smaller activities, we also use the same approach to bucket the capital. Now, what this bucketing helps us? It ensures that we have a regular inflation adjusted cash flow coming our way, plus safety of capital, plus growth of capital. Now, for the benefit of our session, these are 5 areas that are the key challenge that we face: retirement planning, risk management, portfolio diversification, tax friendly approach to wealth protection and preservation, and lastly, achieving our financial goals. So, as I said, in the bucketing approach, for the first 5 years of your funds requirement, at any stage you are, this has to be designed unique to every individual, whether he is a person of 30 years of age or 50 years of age. The solutions are tailored to you. This is a very general view, but when we meet you where you are, as I always use a term, I meet you where you are at a stage in your life to help you reach where you intend to. The first meeting that I interact with my clients or my prospects is something which gives them a very clear picture about where they are and where they should be aiming towards. So the first 5 years of your funds capital should be into debt funds. What does it ensure? A steady cash flow without any risk on the capital. Second bucket from year 5 to year 10 is to enhance the chances of securing inflation beating returns. Now, inflation is something which the government declares, and inflation is what we actually also face on a day-to-day life. Individuals' own inflation is going to be different from what the government declares. Maybe higher, maybe lower, but usually higher. And lastly, anything which is beyond 10 years in bucket number 3, which is a diversified set of mutual funds, which creates significant wealth in the long term. Now, it's a very simple term, mutual fund, but there are more than 3,000 funds today in the market. And we need to be very clear as to which are the ones which deserve our capital. I'm being very cautious when I say we should be very clear which funds deserve our capital, because there are funds which destroy capital because they don't give returns or they do not perform. we should not be into those funds. We should have a system which will switch over to a informed or a curated basket of funds which will help us meet our requirements. When I say one is building the portfolio, second is to a tax efficient way to have a withdrawal plan in place at every stage of your life. Now, this particular table is a secret, truly a secret, because not just because I say so. This is a model wherein what matters at the end result. Is it the market timing, perfect time to buy, perfect time to sell, observing the highs, observing the lows? What does it contribute to the outcome? 2%. Which security to buy? We pick the stocks, pick the bond, we pick real estate, we pick anything else that is available, constitutes 5% of the weightage. But if you are not in the right market, which is the right asset allocation, you are overloaded into real estate, which is not growing for the last 10 years, and you are underweight into mutual funds, which is actually beating the inflation, then you are not doing the right service, or you're not giving the right treatment to your hard-earned capital. So there was a survey done for pension plan managers, and 91% of them said the difference between one scheme and the other one is asset allocation. Now we look at our own survey across India. This is a data coming from a survey done by RBI. Where are we segregating our 100 rupee? Nearly 51%, half of it goes towards real estate and property. Then the share is taken by bank deposits, nearly 13%. Insurance, 5.7%. Provident funds, 5.7%. Cash, 3%. Equity, less than 6%. Gold, 15%. Now, gold has a sentimental value, emotional value. Agreed. Gold has its own value. It's an asset class, and ideally it should be a part of your portfolio, but the proportion should be one which will help us, not the other way around. Equity, which has given us decent returns in the past 35, 40 years in India, and over the last 150 years in other markets that we have data available for, should be having a higher weightage. Now, having said that, as you move closer to your goal, you should be able to safeguard, protect the downside of your portfolio, and that's where the structured product comes in. We'll touch upon it in the next slide. Now, this is a scenario, a sample, as I had said. Somebody who has a 1 crore of retirement corpus, they can easily extract 50,000 rupees per month. While your investment capital grows, your day-to-day needs are met. But the question arises, is 50,000 adequate for your own lifestyle? And hence, one-to-one interaction or a curation of your specific goals, and then planning your portfolio becomes more important. A certain portion goes towards debt products, a certain portion goes towards SP is a structured product, and the balance goes towards the equity fund. There is enough empirical data and evidence to suggest and showcase the effectiveness of these proportions, as we'll see in the next. So you might wonder what would happen after 20 years. A person who's 50 today could be 70. A person who's 40 will be 60. Now suppose if somebody starts with a lakh of 100 lakh, which is nothing but a crore of rupees, by way of monthly outflows, over the next 20 years, the person would have taken payout, which is equivalent to 2 times your capital. Now, the next line is even more important. What is going to be the value of the portfolio even after I have extracted nearly 2 times what my original capital was? It is 200 lakhs, which is again 2 crores. So your crores segregated, parked in a correct manner, would have generated nearly 2.2 crores by way of monthly outflow for the next 240 months. But the investment value has also grown to 2 crores. Now, what would be the monthly outflow at the 20th year, you might ask? Because inflation is going to eat away, right? It is one of the major silent killers. The monthly payout at the 20th year is going to be 1.51 lakhs, which will be adjusted for inflation so that your lifestyle is not compromised. And what is the projected IRR? The compounded annual rate, CAGR or XIRR, which is the internal rate of returns over a 20-year period, is 11.1. Fairly comfortable about the inflation mark. Now the table here on the right indicates what is the time frame that you need to create a certain corpus. It's a very simplistic kind of a ready reckoner. So if I were to take the extreme top right hand side basket, you have a 10-year horizon and you have a 1 crore dream to collate a crore in your corpus. 44,636 is what you would need to invest every month. And as you would notice in the bottom right hand side, even though your corpus is 5 crores, but you have 30 years, then your SIP amount goes to 16,229. Now, I'm sure everyone knows time is the silent factor which works in your favor, which makes compounding to work in your favor. So when I say our approach, how has that been so far? We have data for the last 10 years. AR model portfolio returns, Nifty 50 returns in column number 3. What is the alpha? Alpha is what you have done better than the benchmark. So Nifty 50 is the benchmark. I have done better than Nifty 50 is an alpha. So the last column indicates what is the rupee value on a 10 crore portfolio. Whether it is 10 crore or whether it is 1 crore, you just have to shift the decimal. As you would notice, our model portfolio has delivered an average of 17.1% CAGR returns, whereas Nifty 50 has delivered an average of 12.9%. Now that's a small alpha in terms of percentage, 4.2. But if you look at the alpha generation, it has been a substantial value addition. So there are stages in between where you would have the benchmark doing better. Well, that's market. And despite our best models, we sometimes may underperform. But over a longer term, the model portfolio has outperformed handsomely. So circling back, the 5 key areas: retirement planning, risk management, portfolio diversification, tax friendliness, wealth protection, etc. I want you to ponder onto the quote on the top left hand side. The best math you can learn is to calculate the future cost of your current decisions. This is a very deep and a profound quote, and I like it very much. So, are we addressing the key areas that we have identified? Our approach is designed in a way to beat inflation as compared to any other approach that we would have. Of course, there are many approaches, and there are going to be complex ones and there are going to be simple ones. but I believe simplicity beats everything else. Transparency, simplicity, low cost is what we stand for, not just for ourselves, but also for our clients. The, the product is designed to help you beat inflation, lower risk, ideal for retirement planning or any long term goal. Diversification and asset allocation is at play in front of you. We use a smarter approach, combine the equity, structured product, and debt to ensure inflation beating returns, reduce the dependency on falling interest rate. Now, the banks may have their own approach in managing their books. They are not responsible to give us a fixed return for a longer period of time. Market conditions may change. Market is under no obligation to deliver what you need. We can use the available products, diversify, put them in the right asset class, and achieve our goals. Now, once you create a corpus, once you create your kitty, wealth protection and preservation is super important. Believe me, we interact with HNIs and super HNIs. Most of them do not want returns. They simply say two things: don't ever expose to risk, and I'm happy with inflation plus 2%. If the inflation is 9 for my family, I'm happy with 11 to 12% return. I'm not wanting a 18-20% return. They plan for the risk capital that they can offer to their second generation so that they can also risk those capitals, do something of their own. Risk of losing the principal for increased monthly inflow in future. Principal is expected to double even after inflated monthly payouts. We saw that in the previous slide. That comes from effective risk management. Liquidity at the cost of compromise monthly inflows. Portfolio can be liquid. You do not have to compromise on liquidity. You can withdraw higher amounts in case of any emergency. Your money is not locked, it stays in your demat account. Lastly, after doing everything, are we tax friendly? Are we tax efficient? Yes, we are, because you are taxed at a marginal rate. There is no rocket science here. So before I go to the next steps, I would welcome you to raise a query. If you have, you can put it across in the chat. Anyone? You can always ping in, and we can take the question answers. So what we do is, the offer here is we do a complement investment review of your existing mutual funds, direct equity stocks, any PMSs that you hold, any insurance policies that you have. It is an attempt to do a financial health check for your portfolio. What we deliver after we seek these inputs from you, we deliver a detailed review report of each of your mutual fund holding and a unique 2-page proprietary health card, which tells you if you are overexposed in your existing portfolio, what are the areas you need to look at, what are the things which need your attention to bring it closer to the ideal benchmark. It's a very objective oriented health card which tells you 0 1 1 0. I mean, there is no subjectivity involved into this. Third, we would build and realign your portfolios, whether it is an immediate withdrawal need for retirement or we need to just realign the whole thing for long-term wealth creation. This is the best we can do. And thereafter, if you have any other queries or if you need any further intervention of managing wealth, of having more options, understanding more tax friendliness, you can always reach out to us. To avail this, I welcome you to mail us your CAM statement, which is generally having all the information related to your plan. If your spouse has a separate CAMS account and you wish to share that as well, feel free. Share it on this email ID, ifa.matani@gmail.com. Put portfolio review as a subject, and our team will get in touch with you so that we are able to serve and give a output to you, which will be very objective in approach so that you can take the decision in your best interest. I thank you all for your attention and your patient listening. What we offer is wealth coaching, assessing and de-risking of your investment portfolios, optimize return, reduce risk, curating and aligning for your family's milestone, improvise on the asset allocation. We provide solutions which are tailored to your requirement, and we also provide mentoring for young professionals. The session is open for questions. You may raise your hand and the organizers would unmute you, or you can choose to type your questions. Well, Samay Chaudhary, I would not know at this stage if there is any ETF tracking it, the Karachi 100 index. One has to be a resident of Pakistan with all the legal documents for enabling them to invest there. Best I can do is I can tell you that you can, if you're an Indian passport holder, you can invest into Indian stocks and Indian indexes. I hope that answers your query. Good question, Varun. One should invest into equity markets, stock market, as you call it, because equity is what gives you the opportunity to be a part of the business. And as we saw in the presentation, no one can time the market. And if somebody can, then I believe he would he would not be uh, you know keeping quiet. So the dips are there. The broader indexes do correct, and you get an opportunity to stay invested. See, we can only do investment to the context of our goals and our objectives. And having said that, there is a section of people who also invest only when the markets are rising. They don't worry about the dips. They let others worry about the dips. And when there is a demand coming in, you should buy. So, I mean, this is a simple way. Nobody can time, that is for a fact. But right asset allocation will help you tide over others and take care of the dips or rises. As I explained in my presentation, a structured product is ideal to protect the downside. Youth has something which I don't have. Anybody even a year younger to me has more time than I have. So when you are young, when you have age on your side, having a portfolio of diversified mutual fund in a monthly investment option is the best. A, because your horizon is long term, and B, you have to currently focus and build your career in whichever field you are. You could be an engineer, you could be a doctor, you could be any profession. But your current and immediate thing is to focus and establish yourself in the field of your profession and let the money management happen with established fund managers. So to answer, Yes, a mutual fund SIP is ideal. When I say SIP is systematic investment plan, you can begin with as low as 1000 rupees, and that's perfectly okay. And you could go up to, there is no upper limit for your monthly investment. Jaitra, I appreciate your question. As a academic interest, I would share the intraday trading involves huge amount of automation and execution power. A uh, human being without knowledge might end up hurting their own capital if you look at the percentage returns versus your time which is involved. Now that's the human part of it. Now, does it mean intraday doesn't happen? It does happens. Who does it? Retail people do it, and even institutions do it. What's the difference between the retail people approach and the institutions approach? Institutions use algorithmic trading for ease of entry, exit, and trade execution. Now, that is something which comes at a cost. The infrastructure comes at a cost. The retail people do not have access to technology and execution power as an institution. So it's a zero sum game. If you are long on a certain stock, for example, and you do not book your profits, you do not have a system in place, then you end up uh, being a liquidity provider to somebody else who is short on the stock. So this is a quick overview of the approach that you are seeking to know. Unless you have a very robust system in place, intraday is something which is something which is one should be very cautious about.
So can you just answer the query of Chaitra Shah?
I just
So,
answered that.
so is there any
Intraday trading.
major difference in selling stocks in NSE and BSE?
I think there is no difference. Both of them are exchanges. So if you're staying at a certain locality and you go right when you come out of your society, there is a vegetable market, and if you go left, there is even a vegetable vendor. So NSE and BSE are two exchanges which facilitate the trading between the buyer and a seller. So you open an account on BSE and you open an account with NSE, and that's perfectly okay. And there used to be a time where people used to buy on the BSE exchange and sell on the NSE exchange, which is called arbitrage. So you buy low, you sell high, and you make the difference, and you are practically doing it risk free. Now, can anyone do it? Yes, you can do it. It's perfectly legal. But the algorithms which are working at the back end at the exchanges in a perfectly legal manner, they are first to identify any arbitrage opportunities, and they capitalize on that in huge volumes. So intraday, again, nothing to discourage anyone. You can do it for your academics. You can do a paper trade, but intraday is in a similar fashion. You can buy on the same day and you can sell on the same day. That's what the intraday part is. Who facilitates intraday or who promotes it? Brokers do, because irrespective of you making money or not, the brokers will definitely have an upper hand of gaining a brokerage. Good question, Varun. What is a better approach? Lump sum investment during crucial market conditions, such as a huge fall, or smaller constant investment throughout? I would say both. Uh, Now, giving this analogy to cricket, if you have a good ball coming your way and you are a batsman, you might as well score a six or a boundary. But if the ball is not coming on well, you might as well ensure that the scoreboard is ticking and you take a single. So your smaller constant investments on a monthly or a quarterly basis in mutual funds is your singles, and any market correction which allows you an opportunity which you believe is the right opportunity, you can invest in a lump sum. It's like hitting a six on a loose ball. I hope this answers your query. Thank you. Any query that you would have on the presentation that we have shared, or anything that you might have around it in terms of sustainability, in terms of longevity, in terms of how it operates? So for the benefit of all, I would just add one more thing. If at all you choose to start your journey, our back office team gets in touch with you, get all the documents which are required to open a demat account in your name, connects it to your bank, and we decide upon a certain amount and a certain date for you to start your investments, and we initiate your investments on the given date. Now once that is done, you have access to the app through which you can monitor your month on month growth. So Khushi has a question. Sir, is it the right time to start investing considering market is at all time high? Khushi, I don't know whether you were present in the session, but I should tell you one thing. When we refer to market, I presume you refer to the index, which is the BSE Sensex or Nifty 50. Right? Now, 10 years back, they were at their all-time high as well. Was it the right time to invest? Yes. The markets are designed, the indexes are designed to go up. This is very crucial to understand. 10 years back, you would not have a DMART in your index. You would have a DMART outside your locality. But today, DMART as a business, now this is for an example, has grown so big that the market capitalization of DMART is among the top 100 companies of India. And because it is in the top 100 or a top 50, it finds itself into the index. Not that organized retail was not required, it is just that it was not timed well at that time. But today it components as a larger part in the economy, and hence it finds itself into the index. Am I able to uh, give a correlation? To answer is right time to invest? Yes. We invest for the future. And as we see the growth of India, not just the government figures, every figure, every major broking house, every large institution across the world are pegging India's growth the highest among all countries, developed as well as developing countries. And we have seen this over the last 10 years. So, yes, it is the right time to invest, but make sure that we have the right approach, the right asset allocation, and we have what we focus on is a good risk management approach. Thank you, Kushi. So, Jaitra, should we invest more in ETFs or mutual funds in term or long term? So, most of you from the engineering background, would know what is a glass tracing. If not, it is important. What is a ETF? ETF is a replica of the index. Now, what is an index? It is akin to a bus. We all travel into buses, and all 50 passengers go the same way. Whether person A is in a hurry or person C, he is not in a hurry. ETF are replicas of index. They have their own pace, they have their own way of growing. Whereas mutual funds, and specifically you have a model portfolio or a diversified set of mutual funds, they are like a Uber on a pool. It could probably take you better through the traffic, faster than the bus, and at the comfort. Your objective is to go from point A to point B. ETF, yes, they are a component as well, like a buses on the road. But diversified set of curated mutual funds are like a Uber pool, which will help you cover the same distance, probably faster. When I say faster, has a broader market not grown? Yes, it has grown at 12%. What has been the model portfolio? 17%. And if I were to give you the difference, even 1% over a long term makes a huge difference. 4% definitely makes a very huge difference over a long term. Did I answer your question, Jaitra? Okay, thank you. So, Varun, your question is actually quite interesting. Fundamentals are fundamentals and technicals are technicals. So, there is no two-way to look at things. If you're a technical person, you would be looking at the charts and taking a decision in terms of sector, in terms of a company, in terms of index. Most of the successful traders in the world follow technicals. Now, I'm using the word very consciously. Most of the successful traders in the world use technical. But most of the people who are long-term investors, they tend to look at the fundamentals as well. So, to answer your question, if you're investing into equity for a long term as an investor and you want to create it as a corpus for you to pay for you for your life, then it's a fundamental. But you're doing a short term trading and you want to have trading as a profession, probably technical is a way to go. But the beauty is that if you select working with a profession, you get a diversified set of mutual funds delivered to you in your inbox. And you just have to make sure that you have the right amount aligned for your goal, and that's it. Fill it, shut it, forget it. Then you don't have to look at the fundamentals. The research team does that. Then you don't have to look at the technicals. The research team takes care of it. In India, Anand Rathi has one of the largest research desks to facilitate and work on a predictive model, pick up the right funds for our clients. Was this helpful, Parun? Okay, thank you. So each of you who are attending should at least sit, either seek time from someone whom you trust, Map out your 3, 5 year, and 10-year goals. Whether you are somebody who's about to start their career or somebody who's midway into the career, because I am expecting most of the parents too attending this session. It is important to do a check, avail the offer, get a free health check done. This is a no obligation kind of an approach. If you do not like the outcome, then probably it's time for you to take some action, which is extremely helpful for your future. The way I see it, the career spans are shrinking. The pace of automation, the pace of what we call as IoT is hitting at the heels. Doctors, lawyers, tax consultants, financial consultants, everybody are suddenly finding that AI is going to take over them. Yes, AI is for us to take benefit from. If you do not know how to leverage the power of AI, then probably you should seek it. Work with a professional, understand where you are, where can it lead to, how is the contingency planning done, are you adequately insured as a parent. Keep all these parameters. At Matani Financial Services, what we do is we ensure that your growth, your safety, sustainability, and liquidity, all these four parameters should be working for you. You should not be constrained by a lack of knowledge, by lack of skill. It's good to know a few things, but if you need to have some serious workings on your portfolio, consider reaching out, consider getting the health check done. And once you have a health check done, you would know objectively where you stand. It's like checking the run rate, right? If I'm not able to fulfill my targeted 50 overs in a given run rate, probably I need to change some strategy. किसी बैट्समैन को पहले भेजना पड़ेगा ना. So, Nilesh, all questions are answered, right?
Yes, sir. Yes.
So thank you all of you. Any more questions? I'll be happy. You can ping in. Else, I can be reached. My contact details are there in the message that have reached you. I'll just put across my contact details here if somebody would be wanting to get in touch. Thank you for your participation, Varun, Jaitra, Kushi, Samay. Any more questions coming in? So it's close to 5, and we are near the end of the session. If you have any questions, you can post it here. You can raise your hands, or you can reach out to me on email, or you can give me a call or a message, and I'll be happy to guide you further. And hopefully, we'll be able to have you on board as our clients, ensure that we are able to handhold you and take you towards your financial goals. Thank you, Varun. So people who have registered will receive the recordings after the video is processed. It will be in your inbox. And to people who have not yet registered, we will reach out to them and seek their feedback, probably share the recordings so that they can take it further from there on. Thank you, Shyam. Thank you, Ria. Thank you, Jaitra, Kushi, Varun, Viva Thakkar. Thank you. So I hope all of you had a good exams, the students who are attending the session. Yeah. Thank you, Shreya. Thank you, Ria. Mridul. So we would be ending the session at 5. Uh, thanks, Sakshi. Nilesh, we can end at 5, right?
Yes, we can do that. Yeah.
Yeah. Thanks, Rishita. Thanks, Rishikesh. Good. I noted your message on LinkedIn the other day, Rishikesh Kunde. Thanks, Neil, Meg, Raghav. Thanks, Janvi. Okay. Thanks to all of you. Nilesh, we can end the session, right?
Yes, sir. Thank you for your time. Thank you, participant, for participating in this webinar.
Thank you.